Hello, everyone, and welcome back. Today, I'll walk you through my investment thesis on Amazon and why it remains the strongest conviction in my portfolio. Along the way, we'll also examine some bearish headlines and ask if we are entering an AI bubble. Amazon is a powerhouse of innovation and growth across multiple fronts. It's rare to find such a dominant business underpinned by scalable revenue and earnings opportunities. When companies succeed by expanding customers and competitive advantages, investors typically reap the rewards, though this requires patience and insight. Amazon has transformed the shopping experience. In the United States, more than one-third, 37.6% of all online spending occurs through Amazon.com, far surpassing any competitor. Its marketplace now spans vehicles via Amazon Autos, even offering Hyundai leases and used cars through a partnership with Hertz. Given that only about 16.3% of U.S. retail sales happen online, Amazon still stands to benefit from a growing e-commerce tailwind. Beyond shopping, Amazon is rapidly expanding into digital advertising. In the latest quarter, Amazon generated $15.7 billion in ad revenue, up 22% year over year, a segment typically known for strong margins, driven by marketplace traffic and Prime Video engagement. Amazon's reach extends well beyond these domains. Through Zoox, it is pursuing autonomous driving technology, while One Medical and Amazon Pharmacy highlight its healthcare ambitions. With a market capitalization exceeding $2.4 trillion, Amazon continues to plant stakes across high-growth sectors. AWS remains a financial juggernaut. Its revenue grew approximately 17% in the latest quarter, and its operating margin of nearly 33% positions it as a core profit contributor. As AWS gains greater prominence in Amazon's earnings profile, investors may see justification for a higher valuation, likely year-over-year gains with a rock-solid margin foundation. AWS also powers Amazon's AI strategy, from personalized recommendations and advertising enhancements to robotics in logistics. As a mission-critical IT infrastructure provider, AWS offers services like Bedrock, the Q Generative AI Assistant, and Textract, together with custom AI chips, showcasing Amazon's deep commitment to AI integration. Despite recent mixed guidance for the third quarter of 2025, even after strong Prime Day performance, the stock has held firm around the low to mid $210 range, rebounding from temporary drops. It now trades near its all-time high, highlighting investor confidence in Amazon's diversified growth base. AWS commands about 30% of global cloud market share and remains the dominant cloud provider, despite rising competition from new AI-focused neoclouds. AWS continues to generate strong trailing 12-month operating margins around 36.8% and holds a substantial multi-year backlog of $195 billion. AWS contributes over 50% of Amazon's total operating profit, reinforcing its long-term reliability and growth potential. Advertising also shines as a growth driver. Amazon recently achieved $15.69 billion in ad revenue, deeply integrated with its commerce and streaming ecosystem. eMarketer expects Amazon's U.S. ad share to grow to 17.3% by 2026, driven by CTV partnerships with Disney and Roku. Advertisers are shifting spending toward Amazon's demand-side platform, seeking lower fees, stronger measurement tools, exclusive live content, and better collaboration. Prime Video's rising reach, now around 3.9% of the streaming market as of July 2025, further supports advertising margins. Amazon's North American trailing 12-month operating margins stand at approximately 7% and internationally around 3.4%. Management confirms that advertising remains a key profitability driver across regions. The third quarter of fiscal year 2025 guidance, $176.75 billion in revenue at midpoint, and roughly $18 billion in operating income is conservative, especially following a second quarter beat of plus 3.8% on revenue and plus 25.7% on operating income. This reflects strength across commerce, Prime, streaming, advertising, logistics, and cloud, forming a powerful growth flywheel. Amazon has delivered double-beat performances for 10 consecutive quarters. Analyst consensus for compound annual growth rates through 2027 projects 10.5% for revenue and 18.6% for earnings per share, up from previous forecasts of 10.3% to 16.7%, and building upon historical 5-year and 9-year growth trends. Amazon commands a forward non-GAAP price-to-earnings ratio of 34.6 times, near its one-year mean, 34.5 KPIs, and well below its five-year average, 171 times. Its forward PEG ratio stands at 1.94 times, slightly above the sector median of 1.81s, reflecting its high-growth, profitable nature. The stock trades within long-established uptrend lines since bottoms in December 2022 and January 2023. With a fair value estimate of $126.90, there's potential upside of 439.4%, targeting $319 based on 2027 EPS estimate of $9.22. In summary, Amazon offers a rare combination of scale, profitability, innovation, and diversification. While some short-term volatility may arise, especially around Prime Day or broader sentiment shifts, the current valuation levels offer a compelling entry, especially for long-term, growth-oriented investors. A moderate dip into the low to mid $200 would be a suitable dollar-cost averaging opportunity to accumulate into one of the market's most durable growth stories. Now let's pass on the news of an AI bubble. OpenAI CEO Sam Altman recently said that investors may be overexcited about AI. Yet he also emphasized that AI is one of the most important developments in a very long time. Several articles echo similar concerns. A recent Financial Times piece outlines how staggering AI infrastructure spending, $750 billion by the likes of Google, Amazon, Microsoft, and Meta, with a projected global spend of $3 trillion by 2029, raises alarm bells for speculative excess. Drawing on tech cycle theory, the article suggests that although we may be amid a bubble phase, this could ultimately lead to a golden age of productivity, but only if societies manage associated risks like inequality and monopoly power. An MIT study reveals that 95% of generative AI projects fail to generate measurable returns. That disconnect between hype and outcomes is fueling bubble-like fears. Other coverage from the Washington Post acknowledges parallels to past technological cycles like the dot-com boom, but makes an important distinction. Transformative innovation often follows hype. Even if many current AI ventures fail, survivors may redefine industries in the long run. My view, while certain companies, especially startups with speculative valuations, may indeed be overvalued amid this AI rally, many mature players are reasonably valued. Giants like Amazon, Microsoft, and Google offer solid fundamentals, real profits, and clear paths to monetization. In fact, today's elevated risk environment could accelerate structural improvements, drive meaningful adoption across sectors, and fast-track long-term change. So yes, investor exuberance is heightened and caution is wise. But dismissing AI's broader potential misses the point. Real innovation may emerge from this hype-filled era, crafting lasting value even as weaker players fade. That's all for today. Thanks for watching. See you in the next one.